Good morning, ladies and gentlemen. Good morning, ladies and gentlemen on the dais. It really is a great pleasure for me to be here at the Global Inclusive Summit meeting this morning. For today's discussion, I just want to share with you our own experience and case study of what we are doing in inclusive financing and what is really, what are the few factors that are actually powering this up. So number one, I must say that I've categorized the 5 kinds of inclusive financing happening in the country today. Number one that we are doing is basically business financing. Typical profile of people we are lending to is basically, you can see it on the screen here, entrepreneurs which are maybe having turnover of anywhere between 10 to 50 crore. These are typically how their offices look. Now, this is a customer who's processing chili, somebody is processing cotton trading, someone is doing maize and paddy, someone is doing electrical items, somebody is doing wholesale trading. You can see somebody trading aluminum sheets, trading medicines. So these are the kind of people that we are financing. This is a picture and profile of people whom we are financing in the micro-entrepreneur category. This is one that has been truly underserved in the country thus far. The typical income of this profile is 280,000 to 3 lakh rupees. The average loan provided for these people is about 1.5 lakhs. Now, the other sector profile which we are financing is tractors. In tractors, typically, again, people have a household income of 4 to 5 lakhs. Average loan amount is about 5 lakh rupees, and typically livelihood, agri, dairy, processing, etc. Now, typically, Kisan credit card is people, again, security of property in this case. And again, household income close to about 8 to 10 lakhs, average loan amount 13 lakhs. Just moving ahead in a quick way, that is one category, business financing. In business financing, long and short of it is that you're financing a business, they're doing economic activity, they're earning, they're paying you back. That cycle closes and the loop closes like that. The second category of financing is livelihood. In the livelihood financing, what we are doing is basically financing poultry, cattle loans. Here, you finance a livelihood, they earn from the livelihood, and then they pay back the lender. Third category is skills. You know, could be polytechnic institutes, could be beautician, electrician, plumbers, mechanics, yoga, fitness. So, unlike business financing, here you taught a skill or you financed a skill. The person took maybe some time to translate that skill into an economic activity, and then they pay back. Now, I want to share with you the next category of financing is when we finance, productivity improvement. Oftentimes, we tend to think of consumer durables as consumer durables. But if you see the life of someone who's washing clothes, and all of us who would have been in the lower income profile in the prior generation or in this generation, we realize that washing clothes in a day takes away 1 hour, 1.5 hours for the family, maybe 2. Now, washing machine does it in maybe half an hour or 20 minutes. So it's a massive productivity enhancement. So our bank, for example, has financed close to about 1.9 million washing machines. Mobile phones, we all know, the poor did not have access to mobile phones. At least now the mobile phones have become 5,000 to 6,000 rupees, or maybe 10,000 rupees to get a mobile phone. We have financed close to 12 million mobile phones. It is a connectivity tool. We have financed close to 3 million refrigerators. In one of the interviews I was having with one of those people in that segment, that person told me, once my refrigerator has come, now I can buy in larger lots. I can buy milk in larger lots. It can last a longer time. So these are massive productivity hacks for people, because people in this room typically take all these things, air conditioner, mobile phones, refrigerator, washing machine, we take it for granted. But really in the rural location, it is not so. So we have financed these, and close to about 30 million of these customers we have financed thus far. I find laptops is a real issue, because during the COVID, we found many people trying to read, especially poor children trying to read from the mobile phone, if at all they had a mobile phone. Now, the rich children, well-to-do children reading on a laptop and absorbing it even through COVID. Like my middle class also. But the poor were accessing through mobile phone. It's impossible for them to learn. So the rich-poor divide of capabilities only expands because of lack of a laptop. So think of laptop also not just as a means to play games or something, but it's also a means for learning for children. So my comment, therefore, is that each of the consumption items, what consumer durable items, are enhancing productivity for the people at large. We started in this bank toilet financing. Now, we started financing people who wanted to do, hand pumps, then the septic tank, then the pipes that come from the septic tank to the home, then the water purifier. We finance the whole chain. And we have provided financing to these people. And I must share with you the typical loan amount size of the toilet that we are financing is about 39,286 rupees. This is the numbers from our bank's books. And we offer the customers zero prepayment fee. We say you can close that loan anytime you want. And you'll be surprised, these people are paying back. I'll show you the previous page. The repayment rate is 99.7%. Our NPA, I'll show you on the slide, is very important for you to note that what I showed you, consumer durable, the washing machine, the refrigerators, and toilets, everything. The consumer loans, you can see gross NPA is 1.96% and net NPA is 0.52%. You can see that loan against property, which is a property secured having gross NPA of 2.3 and net NPA of 1. Now, similarly, SME loans, I showed you the different category of business people financing loans. It is running at 1.42 gross and 0.47 net, which is pretty low for uninitiated. So then you might think that this is maybe a one-time. I'm going to show you why it is not one-time. Over a period of 13 years, starting from 2011 to, we're not touching 2023, we started in 2010, the gross NPA always has been just 2% and net NPA has always been 1%. 13 years is a long time to operate in this segment and still have low NPA. Now you might think, as some of you who are in the industry, might think that NPA at this percentage very low can be managed by writing off loans. But for that, I want to show you write-off data. Right? There has not been a single year in our entire history that we have taken one-time credit write-off at all. Never happened. Its profits have only gone up that way. And the only time, ironically, that we had a problem in credit was when large loans went bad. It is never the small customer. You can see that 6 bar graphs that went below. That was at the time of merger. After merger, for 6 quarters, we had some losses because of large loans, and there were well-known infrastructure loans and all that. And they were all, ironically, those were the so-called larger corporates. So the point is that the small customer never defaulted on you. Large corporates did. Lastly, why is it behaving so well? Many people ask us, look, how is it possible that this segment behaves so well? I'll tell you why. Why is important? Because all in India, thanks to the many initiatives of the Reserve Bank of India and many initiatives of the Government of India, cash flow evaluation has become very easy. Because before GST, you could not assess cash flow through the GST. Today, GST has become a massive source of cash flow evaluation. Bank statement, now, for example, earlier, if you had to finance somebody who's a chai person and somebody has to sit there, count the number of cups of tea they're selling and multiply that by 10 rupees and then estimate the income. You don't need to do that anymore because they're all taking QR codes, money is coming to the bank account, you just have to see the bank statement and you have to lend to the person. Irrespective of how many cups of tea they're selling, it's coming to the bank statement. So this massive digitization the country has done has made a big difference to this data about cash flow assessment. I'll just tell you why, for 75 years this did not happen, and why suddenly it is happening now. I mean, in our case, at least I personally doing this for a long time now, but at least as a nation, we did not make much inroad. Why? Because this is how banking was done for a long period of time. Now, if you think of this is how people were always busy in a branch, how they can do inclusive financing? They're busy closing, the books of the day and, paying cash, receiving cash, and doing non-value adding transactions. This is really how banking worked. So, just since Tamal is there in this conference, I remember Tamal interviewed me in 2018. And in one of the interviews, I told him, what has not happened in 50 years will happen in 5 years. This is in 2018. I'm just telling you, this is now 2023. Really, in these 5 years, India did much more than what it did in 50 years. So I want to just close the presentation, folks, here. Ladies and gentlemen, it's a great pleasure talking to you. And I'm hoping through this live case study of what we presented about what we are doing in this segment, you will get greater confidence of being a part of this segment. It is diversified, it runs into many businesses, it is supported by cash flow, and finally, it is meeting a particular social need, a segment which never got credit. And earlier, the rich-poor divide is only increasing, but if credit reaches the bottom of the pyramid, it doesn't have to increase. It can actually, the graphs can converge. Thank you very much, ladies and gentlemen. Bye.